Okay, welcome back, class. This is chapter 9 video covering liabilities, and in this chapter I want to cover a lot of the material that we're going to be talking about on Wednesday. We started into this area today, but I need to really finish this up and have you look at this video before Wednesday. So here's what we're going to do. I'm going to go through this chapter, I'll put this video up, and then as you go through it, be prepared then that we will work with problems from this chapter on Wednesday and review some of the material that we just are going to talk about here. So liabilities, what are they? Well, first of all, we define liabilities to begin with as a future payment that we're going to make based on something that's happened in the past or a current obligation that we have or something that may happen in the future. So basically, there are three ways that we can incur a liability. And there are two basic liability types. One will be a current liability, and the other one will be long-term. And for the sake of this chapter, most of it's going to be with current liabilities. We're not going to deal much with long-term yet, although we will deal with those in the future. So when we're looking at current liabilities, what we look at is what we owe in the short term. Now, for example, short-term liabilities are going to be less than a year. Anything that's going to come due in the current 12 months. Now, that would be typically things like accounts payable, short-term notes, any taxes that we owe, things like that. Long-term liabilities are obligations that are due after a year or in the future beyond that. So, for example, if we were borrowing money to expand our business, and many businesses, especially large businesses, will go out and do a bond issue for this. And the bond issue may last 10, 15, 20 years into the future. That bond issue will be like signing a big note. They will sell their bonds to the public. They'll raise money. They will owe that money in the future with interest. They're going to pay interest on it. But that is beyond the current 1 year business cycle. So we're going to call it a long-term debt. Now you may have also a portion of that long-term debt will be due in the current year. So we'll calculate an amount that you'll want to reclassify into the current liabilities in each year. So for each year, we'll calculate a current liability portion of the long-term debt. There may be uncertainty in liabilities. We may not be certain who we're going to pay. We may know what we owe, but we may not know exactly to who it's due. This would be the case if we had a bond issue. Bonds can be purchased or sold by anybody once they're on the market. And so we have sold our bonds out to the general public, and they may continue to buy and sell those bonds after we sell the initial bonds and raise the money. What we will do is we will pay the interest due on those bonds to the bondholder of record so that that will change with time. There may be one person that starts with the bond and then that changes to somebody else later on. So that interest payment may start with the original bondholder or purchaser and then move to somebody else when they sell that. We may not be certain when we're going to pay something. So we may have an amount that we know is due, but we may not know for sure when it's going to be paid. So that would be something that we may have a contingency for. For example, if in the case where they talk about there's a law firm, they have a liability that they're settling at an unknown future date. We don't know exactly when that's going to happen, but we know the liability is out there. So we may not know exactly when it's going to happen, but we know it will happen. We may have an uncertainty into how much we're going to owe because we may have an account with our utility company based on how much we use. And that changes every month. So we may have a month where we have a lot of power usage. And so we have a higher utility bill that month than we typically have. Accounts payable are going to be very predictable. We're going to know what those are because those are our traditional suppliers that we use. We may have people that we're buying merchandise inventory from, supplies from, equipment, other things. We're going to know the amount that's due on those, and we're going to know to whom they are due. So those are going to be very predictable, and we will be able to know with certainty who we have to pay. Sales taxes payable. These are due to the government for the sales tax portion that we owe when we sell our goods in a transaction. Everybody collects sales tax, and they pay it to the state that they're located in. Now, when we live in Indiana, the current sales tax rate is 7%, and so we collect a sales tax of 7%. Every merchant does this, and when we sell something, we're going to calculate that sale price times the amount of tax that the customer will owe, and the customer will pay us, and we will turn around and pay that sales tax to the government. Here's an example. We have a cash sale of $6,000. We're going to collect 5% tax on it, and that tax will be $300. So we'll collect a total cash of $6,300, but $300 of it belongs to the state. So we will basically, when we sell that, we'll establish this liability that we'll owe this money to the state. So that's a short-term liability, and we will need to reconcile that every month and typically pay sales taxes at least once a month. Now, unearned revenues are when you have a performance of some kind, like the example that we talked about today with a concert, or here Rihanna selling tickets, somebody else, anybody else selling tickets to a concert or to a sports event. For example, if the Colts are selling season tickets, you buy a season ticket, you have tickets to many games at home, not just one ticket. So you have many events. When they sell the season tickets, they'll have a certain amount of cash that they will raise, and that amount of money will go into unearned revenue here, just like this, unearned ticket revenue. And then as they host the events or host the games and the teams play, then they will recognize whatever portion goes with each of the games. So for example, with the Colts, if you have your first game of the season played, you're going to record whatever ticket revenue you'd have from one game, recognize the debit to unearned ticket revenue, which will reduce the overall portion of unearned revenue, and then you would take that amount into revenue as earned revenue. Short-term notes payable are going to be things that you take out for 60, 90, 180 days, something like that. And it may be related to a couple of different things. One of them might be that you have an accounts payable you can't pay the full balance on, and so you negotiate with your vendor and say, look, I'll give you a note for the balance, pay you a portion, and that note for the balance will include a payment on interest, a certain percentage of interest. So in this case, it's $100 cash and a 60-day 12% note that will be paid, and that 12% will be interest. Then when you actually pay it, when you actually pay that note off, now I want to mention here, when you set this up and you trade the accounts payable out for the notes payable, you're going to debit the accounts payable for the entire balance, show the $100 payment, and then the credit for the new balance on the notes payable. So that signing of the note will then change that accounts payable to notes payable. And then when you actually pay the balance on the note, the 60-day note, $500 60-day note at 12%, you calculate the interest that's due, and in that length of time, you'll owe $10 interest. So you're going to record $500 debit on the notes payable, $10 interest expense, and a total cash payout of $510. Now, if you go to the bank, you're going to have to sign a note to borrow money. It'll look a lot like what we just looked at. You'll have a debit to cash for the money you're borrowing and a credit to notes payable. And when you credit notes payable, you want to record the terms here so that you can keep track of when it's due and what the interest rate is and so When you pay that back, you're going to debit the notes payable for the principal amount. You'll calculate the interest that's due on this. You'll have the $2,000 at 12% times the 60 days. That'll be $40 here, and you'll have a total due for cash. You're going to credit cash of $2,040. What happens if that spans the end of the year? Well, we did this in class today, but what happens is if it goes across the end of the year, you need to record accrued interest payable at the end of the year. So in this case, they have part of the interest from December 16th to the 31st. That's accrued interest payable. And what we'll do is calculate it. And here it's $10. Debit interest expense, credit interest payable. That's the accrual of interest that's payable. Then when we pay the note, when it comes due February 14th in 2019, we're going to show the interest expense of the balance, which is calculated here as $30. We will debit the interest payable because we're paying it now. We will debit the notes payable because we're paying it now. And then we'll credit cash for $2,040 because we're paying the note with the interest that's due. In these need to know sections, they go through these examples that we discuss here in more detail, showing you an actual calculation. And I would recommend that you look at these just as examples for actually doing one of these problems, knowing how to record the journal entries. With payroll liabilities, you're going to record the gross pay for your payroll for an individual. So you have an employee who will earn an agreed upon wage, and then that's the gross pay. And then out of that payment, you're going to record the liability for federal income tax, state and local income taxes, any voluntary deductions, FICA for Medicare, FICA for Social Security, and then the net pay. So you calculate the federal income tax based on the withholding allowances they file. State and local taxes the same way. Now in Indiana, we have county taxes for local taxes, but we do have local taxes. Voluntary deductions, and then the Medicare portion of the FICA would be at 1.45%. That's unlimited. There's no cap on Medicare, so you pay that 1.45% on all wages. With Social Security, however, there's a cap of $127,200 in the book. Actually, that's been bumped up a little bit. I think it's $128,700 now. But in the book, it's $127,200. And once you hit that amount, you no longer pay Social Security tax. Now, the Social Security tax that you pay is 6.2%. So for an employee, you're going to calculate the withholding for federal income tax, state and local, any other deductions, Medicare, and Social Security. And all of those are going to be payables that you're going to record. The journal entry will look like this. Let's say we had an employee that earned $2,000. These might be the withholdings on that employee's pay. We show a payable for Social Security of $124, Medicare of $29. We show federal income taxes payable $213, medical insurance payable, employee union dues payable, and then salaries payable. Now we will record that as a payable because we're going to calculate this before payday, and then we'll go through and process this on payday. We'll debit the payable and credit cash and actually make that payment. Employer payroll taxes are matched to the employee payroll taxes, at least for FICA. The FICA taxes, the Federal Insurance Contributions Act, came in the 1930s after the Great Depression in order to provide retirement income to elderly who were the ones who were most hurt by the Depression in the 1930s. So this act basically provided some sort of a pension for them. Well, with Social Security, again, the employer will contribute 6.2% to match the employee's contribution, and then another 1.45% for Medicare to match the employee's contribution. Employer's tax would also include unemployment taxes, which the employee never sees and never pays. But unemployment taxes include the state unemployment tax, and in this case, they're showing an example of a state unemployment tax of 5.4% for the first $7,000 in wages. Now, in Indiana, this has all changed a little bit, especially after the mortgage crisis. But with the state unemployment tax, you're going to calculate the 5.4% of all wages and then pay that to the state as an employment tax. Now, it is possible that as an employer, you have a merit rating and you may be charged a lower rate if you don't have many unemployment claims, or you may have a higher rate if you have a lot of unemployment claims. The federal unemployment tax is a FUTA, and that's really an administrative fund that's set up. And basically, what happened during the mortgage crisis was that many states borrowed money from FUTA in order to pay their state unemployment taxes. So the FUTA tax basically is at 6%, but gives you a 5.4% credit, which means that you're actually only going to pay 0.6%. As a result, if you're paying 0.6% on 7,000, it's a very small amount, and as a result of that, you only file the FUTA tax once a year. State unemployment tax is going to be computed monthly or quarterly, depending on the size of the employer and the amount that's due. So when you record the employer portion of payroll taxes, it's going to look like this. You'll debit payroll tax expense, and then you'll credit all the payables. Social Security tax payable, Medicare tax payable, unemployment taxes payable for the state, and then unemployment taxes for the federal. And all of those items are going to be payables. And then when you actually pay those, you will debit the payables and credit cash. There's a talk here about the internal controls in 4 key areas of payroll. The issue here is that there may be and can be sometimes fraud that occurs with payroll, especially if you have ghost employees or maybe improper time records or something of that nature. And anyway, when you do this, when this sort of thing happens, there are controls that you can have in place to make sure that you are authorizing payments correctly, that you're processing the time properly, and that the payroll payment is going to the right place. We don't really write checks anymore. We do direct deposit, but there are a lot of safeguards you can put in place to make sure that that direct deposit is going where it needs to be, that the time that the employees are working is actually captured and recorded. Usually it's not through a time clock like this. It may be through an ID badge or even a handprint, a scan. But then that the payroll preparation is carefully evaluated and approved. Now there are multi-period known liabilities, and some of these are going to be the long-term debt, like I mentioned, and typically that's going to be bonds. So if you are a business and you're borrowing to expand, you may have a bond issue that goes out for many years. So we know what the liability is, we know what the interest due is, we know what it's going to be. However, they talk about one here that you might not have really thought about. They talk about Sports Illustrated with the subscriptions revenue. They talk about receiving subscription payments that extend out for multi-periods. So you may, I don't know if you've ever done this, but you may have somebody doing a fundraiser and you order a couple of magazine subscriptions as a part of that fundraiser. You may have a 2-year, 3-year, or 4-year magazine subscription. If you are the magazine company, you record it as unearned income because it's unearned income until you actually have a magazine to deliver to those individuals. So you'll have the entire thing going into unearned subscription revenues until you start sending the magazines out, and then those become earned revenues. If you have a long-term debt or even multiple years of subscription revenues, you will have a current portion of that liability, which is what's going to come due or actually be earned in the current year. So in the present 12 months, you'll move that liability out of the long-term debt. This is a case of you actually have debt, not unearned revenue, but you have a long-term debt like a bond, and you're recognizing the current portion of that debt. So you're going to pay off or pay $1,500 on the current portion of the long-term debt. Basically, this is not necessarily a journal entry every time, but there may be a case where you have to do this as a journal entry. But you definitely will reclassify this in the balance sheet and show this as an adjustment to the balance sheet to record the current portion of long-term debt and subtract it out of the long-term debt and put it in the current obligations. Okay, so there's some more information about details of payroll. We're going to talk about estimated liabilities next. You have pension costs and health costs. And if you're estimating liabilities here, you're going to be talking about an accrual, an actuarial calculation, where somebody will come in and estimate employee benefits expenses or perhaps pension plan benefits. Companies that do this regularly, one that comes to mind was valuation counselors. They have actuaries on staff that will come and evaluate a company and look at the pension obligation and look at the employees that are going to be eligible for that and determine what that liability is going to be. When you actually are setting this up, when you want to set the money aside, you'll have for health and pension benefits, you'll have a benefits expense, and then you'll show a credit to the medical insurance and then the retirement program payable. Vacation benefits are going to be a lot like that. You'll have an obligation that an employee may earn over a period of time. So as they work, they earn a little bit of vacation time as they go along. And as that continues to build, then you record that as an expense and as a payable because you want to identify that vacation obligation that you have for those employees. And then when they earn it, when they actually receive it, you're going to debit the payable and credit cash. Now, employee bonuses are the same way. You're going to recognize those in the event that you have a bonus you're going to pay. So you're going to basically set that money aside, and warranty liabilities as well. In this case, you'll be typically looking at large ticket purchase items like a vehicle, where you have a specific warranty period and a calculated rate that you estimate that you're going to have to pay out. This will be to set money aside to repair the vehicles if they come in under warranty. And then you may have some estimated liabilities that'll be both long-term and short-term, and those extend over some period of time. This can be pension liabilities. Those are long-term liabilities typically. Okay, we're going to talk about contingent liabilities, and a contingent liability is a liability that could happen or may happen or may be probable to happen. Now, we're going to look at these in three different ways. We're going to say, okay, what is the contingent liability? And if it's probable, if it's probably going to happen, then we're going to estimate it and record the liability. If it's possible that it will happen, we will disclose it, and it's not, if it's probable it will happen or if it's possible it will happen, and we can't estimate it, we're going to say, okay, we'll disclose it in the footnotes of the financial statement. So this obligation that could happen, but we don't know how much it will be, or it's probable to happen, but we don't know what it will be, would be disclosed. Many times these contingent liabilities are lawsuits or class action lawsuits of some kind where there's some issue with a product or with a policy of the company. For example, both Dollar General and Family Dollar stores were sued many years ago because they basically paid employees as if they were salaried managers, but they were actually being employed to work as if they were hourly employees, but they were not being paid overtime. So there was a class action lawsuit against both Family Dollar and Dollar General, and they lost the lawsuit. They had contingent liability set up in the financials, but they were appealing the lawsuit. So I don't know the ultimate outcome of that, but they did have at least a calculation for what they thought the liability could be. A contingent liability may be remote, and if it is, we're not going to disclose anything, and we're not even going to talk about it. The issue here is if you have a contingent liability and you record it, you don't want to record it too soon because you do not want to maybe influence the outcome of the event. So these are the cases here. This is how we apply those. And these are the rules that we would use with contingent liabilities. And here are some examples of how they actually apply those. You have possible legal claims. Ford Motor Company has a very blanket statement here saying that they have claims pending. They don't have an amount, but they basically state that they have them. The Boston Celtics are talking about guaranteed payments for players. So basically that's a guarantee or basically guaranteed salary in the event of an injury. And then if you have other contingencies, in this case it would be the oil company Chevron, for example, if there were possible claims related to environmental issues like a leak at an oil well or something of that nature, those things might actually require some obligation from the company and possible future payment. So those are really the liabilities that we want to talk about here. And what I want you to do is to take a look at this video, go through it, and as we work through these problems on Wednesday, you'll have some more familiarity with the content. So look forward to seeing all of you on Wednesday, and be sure to watch this video and be prepared for the worksheet on Wednesday that we're going to go through.